The efficient emergency fund. What do I mean by that? Well, an efficient emergency fund does more than one thing for you, right? It can protect you in 5 different ways. Why is this important? If you're anything like me, your emergency fund looks like some cash sitting in a bank account, right? And so myself, for the longest time, was just letting money sit there, right? And maybe it's growing a little bit here and there, and maybe I'm able to pay the bills off that I need to, but it didn't serve me in more than one way. And so what I discovered was that there was a better way to develop an emergency fund. And so here's the conclusion that I came to, and here's the solution that I found for myself and my family, and I want to share that with you. So the right emergency fund, I believe, should protect you in 5 ways, not just one. And I want to talk to you about all 5 of those ways. But first, I got to talk a little bit about what a typical emergency fund looks like, and then we can build from there. You know, a lot of people are going to recommend that you start with about $1,000 just to protect you, right? If you have some sort of small emergency, right? You need to replace your water heater, you need to bail your friend out of jail. I don't know, whatever it may be, right? So regardless of where your consumer debt is at that point, you need to make it a priority to have at least $1,000 of working capital that you can draw from at any time. But beyond that, let's talk about what a true emergency fund does look like, because realistically, if I lose my job or if I become disabled, I have a medical issue, right, or a lawsuit I'm dealing with, I need to have about 3 to 6 months of wages, or at the very least living expenses, saved up. This is just to carry me over in the case of a true emergency. And I need to have access to it. But typically, these emergency funds have minimal growth because they're just sitting in a savings account, right? Typically, they can also be exposed to creditors, right? So if I owe money, I could have my accounts exposed to different situations where I don't have control or protection of it. There's also no added protection in case of a death, disability, or a terminal or chronic illness. So I want to show you how you can add all those 5 things to your emergency fund very simply without losing any benefits. So let's talk about how you do that. Number 1, you use a specially designed life insurance policy. You're working with a dividend-paying mutual company. What that means is that you are partnered with the company. You're not a stock owner in the company. You are part of the company. So when the company makes profits, they pass those profits down to you through dividends. And these dividends are growing your cash value. This is how your policy generates interest growth over time and can outperform these high-interest savings accounts that you may see out there. So it's also very important that you're using a combination of permanent and term insurance. Term isn't always needed, but most of the time it is. And so with the permanent side of the insurance, you're going to need to use whole life. I would definitely encourage people to steer clear of any other permanent insurance than whole life. We're not here to talk about using an IUL or any other universal life. We're talking about whole life policies where you have certainty, safety, and protection. So let's get into it. What are those 5 benefits that I'm recommending for you personally? Here's why. Number 1, worst case scenario. You die, right? And for this case, what's going to happen to your money if it's just sitting in a bank account? Well, it's going to be passed down to your heirs. It might go through probate court. Who knows? But I can tell you this. If you had turned that money in your bank account into a whole life policy, then you would immediately have coverage, right? You would immediately have death benefit to cover you for in the case of your death. So this is where a combination of permanent and term comes in, because permanent gives you that foundation of cash value that builds up, and term is like renting insurance. It will cover you if this happens. so that you have way more death benefit than what you are paying for, right? And so you're renting that death benefit. In the early years, this is extremely important. So the second part of this worst case scenario benefit is if you become disabled, you can add a rider to this policy. And what this rider does is it will pay your premiums for you. The insurance company will pay your premiums for you in the event that you become disabled. So this is going to cover you in that case. And then C, there are a thing called living benefits. So you can add a terminal or chronic illness rider to your policy, which ensures that you have access to that death benefit amount before you die in the case that you become terminally ill or chronically ill and need money for your healthcare expenses or your long-term care. So why wouldn't you want to do that? Why wouldn't you want to add this benefit? Number 2, you're getting the growth better than a high interest savings account, right? Because typically what you can expect in a policy like this is an internal rate of return of around 3.5 to 4.5%. Now, I say internal because you are going to have costs when you open up a policy, and typically those costs are loaded on the front end. And so that's why it can look like your policy doesn't grow very fast in the first few years, but over time it becomes more efficient. It grows faster and faster. Now, in reality, it doesn't grow faster. The growth in your account is determined by the dividends that the company is paying you. And those are very reliable, and these have been around for centuries, okay? But the point is that when you average it all out, you're looking at around 3.5 to 4.5% growth. And this is all tax advantaged, meaning if you set this up correctly with somebody who knows what they're doing, that money is going to grow tax-free. Your money in a high-interest savings account could potentially match that percentage, and it can fluctuate for sure, but it's still going to be taxed as income tax, right? So you can think of this like a Roth IRA, but you have complete liquidity, right? So you are able to access those funds whenever you need them, right? So you're not going to have the potential upside of growth in the market from a Roth IRA, but that's not the point, because this isn't an investment tool. This is an emergency fund, right? And so what you want to protect yourself is from the risk, the downside risk of the market, where you see it fluctuate. It could go up, 10% one year and down 37% the next. You never know. The point is, in an emergency, you want to be able to have access to that money, and you want it to be safe and certain, right? So it also allows you to have a consistent plan for saving. If you're like me, you need to have a disciplined amount set aside that you're saving, or else you won't save, right? You'll spend that money, right? And so this is going to help with that. The other thing is, if you already have an emergency fund, right, or you have a lump sum of cash that you're coming into, you can immediately dump that into the first year of your policy to kickstart that emergency fund and get it growing faster. So that's certainly an option, to just transition from your bank account, right, into a specially designed whole life policy to give you the maximum efficient emergency fund, right? So we're going to look at benefit number 3, which is accessibility. So typically you can expect to receive your funds within 2 to 3 days after requesting your funds from your life insurance company. So let's say that you had an urgent need, right? And let's say you didn't have that $1,000 in the bank, right? Even if you had a credit card, you could pay for that urgent need. And then when you receive your fund in 2 to 3 days, you can pay off your credit card. So accessibility is great here. It's amazing. It's unlike a taxable account, like if you have in the stock market. If you pull those funds out, you're going to have to pay capital gains tax on those funds that you pull out, right? And maybe it's not the right time for you to be pulling money out of those accounts, right? And what if it's, an account like an IRA or a Roth IRA? Well, you're looking at a 10% fee for early withdrawal. So you're really going to penalize yourself by withdrawing from those funds. Those are intended to be left alone for retirement. So you don't want to be pulling those out and trying to use those as an emergency fund. And then C, you can take a withdrawal or a policy loan. So a lot of people ask the question, Daniel, why would I take a loan on my own money? Why wouldn't I just use my own money? I don't like that I don't have access. I have to loan my money. Okay, first of all, you can withdraw your cash value from your policy. But the question is, why would you do that? Why would you withdraw your cash value when you could take a policy loan? Because when you withdraw your cash value, you lose the associated death benefit, right? So whatever amount of money, let's say you took out $10,000 and that $10,000 was worth $100,000 of death benefit. Well, now you've just lost the ability to capitalize on that death benefit. Like, you've lost that amount of protection. So instead, you take a policy loan against your policy, right? So your policy loan is with the insurance company. They're loaning you money from their general fund, and they're using your policy as collateral against that loan, so that if you don't pay that loan back, they just take it from your policy when you die. Your death benefit will cover that amount. And so it's a very secured loan on their end. So the interest rates on a policy loan are very competitive, and they are in line and fluctuate with the federal interest rates and the growth of your policy. So the dividends that the company pays, the profits that the company makes, those also affect your policy loan interest rate. So they can be very, very competitive with other types of interest rates out there, like mortgages or automobile payments, and certainly way better than any sort of a credit card interest rate. So let's talk about benefit number 4, protection. Protection from creditors. Well, first let's talk about privacy. So your life insurance information doesn't need to be disclosed on loan applications, college assistance through FAFSA, or the federal government. So the point here is that, let's say, for example, you were applying, your son or your daughter was applying for college assistance through FAFSA. Well, they're going to ask you, how much money do you make? How much money do you have? And if you're overqualified, your child may not be qualified for FAFSA. So it's very good to know that you don't need to disclose any sort of financial information about your policy, right? They can leave this off the books, and it will not affect their ability to get a loan in the case that they need one, or not a loan, but financial aid or assistance, right? And number 2, protection from lawsuits, divorce, bankruptcy, and overdue debts. This is super important to me, and these laws differ state to state, right? And so, but the point is that you're going to have some level of protection here. And so if you want to go into detail, you need to look at your specific state laws. But to give you an example, in federal bankruptcy, your death benefit is completely covered. So if you die, right, you still have all that death benefit covering you, right? A creditor can't touch that. Bankruptcy can't touch that, right? And up to $13,400 of your dividend, interest, or loan value is covered, which isn't a ton of money, but it is something. Now, of course, that's with federal bankruptcy. You need to look at what state bankruptcy looks like and all the associated state laws, but guarantee you're getting better protection here, way better protection than the nothing that you get from putting your money under your bed or putting your money in your savings account at the bank. Okay, so, and finally, number 5, benefit number 5 is opportunity. Wow. You know, they say that opportunity comes to those who have cash sitting on the sidelines waiting to be utilized. And so once you have your 3 to 6 months emergency fund, anything that you generate above and beyond that is now free capital ready to be used for opportunities, right? Maybe that business that you wanted to start or buy. Maybe it was that real estate, that rental property, the Airbnb. Maybe it was the car wash that you wanted to buy. Maybe it was that online business that you wanted to start, right? And whatever it might be, now you have capital to give you a greater return on your investment. And so you have this fund ready and available to use at your will. The other thing is that you have the opportunity to reduce interest on debts such as automobiles, mortgages, and credit cards. Now, sometimes it's very advantageous to do this, and sometimes it's not. And this requires looking at it on an individual basis, right? But one of the very cool things about a policy loan is that you pay it off at your own pace. You get to decide how you want to pay that policy loan. It's simple interest charged up front. So if I took simple interest at 4% interest on $100, then I owe $4 in interest that I pay up front. Now, I don't have to pay that loan back ever. if I didn't want to. Of course, I don't want to do that. I'm going to discipline myself to pay it back. But let's say that I were to pay that $4 off in 6 months instead of a year. Guess what? I get credited that $2 back, right? Because I didn't use that whole year. I paid my loan back in half the time, so now I'm paying half the interest back. You know, a lot of times when you're stuck into an amortized type of situation, you don't have control over that, right? And so you're going to have to end up paying that interest over the course of the lifetime of that loan. Whereas with a policy loan, you can really take advantage of the fact that you're in control of how the repayments work. And there's so many different ways that you can benefit from that. So those are the 5 benefits, right? That's just a minimum starting place of the benefits that I can think of from shifting my money from my bank account to a specially designed whole life insurance policy, an infinite banking type of policy. So infinite banking is just about taking control, right? Personalizing, privatizing the banking function of your financial portfolio and taking back control. And so you're going to want to work with somebody who is an expert at infinite banking, because your typical life insurance agent, as great as they are at what they do and as well-intentioned as they are, most likely they have not been trained in how to set up a policy like this. And that's why you need a professional. That's why you need somebody who's been trained in how to do this the correct way. So let me give you just a quick practical example. Let's say your annual income is $60K. That means your emergency fund goal should be between 3 and 6 months of your income. So you're looking at 15 to 30K. And then your death benefit, a good round number is about 20 times your annual income. Now, the younger you are, the more you will need, because if you were to pass away at 30 and you're planning to retire at 60, that means that's 30 years of your annual income that you've lost, that you probably would have made more as you get older too, right? But the point is then maybe you need to 30x your annual income to replace that what was lost, to cover your family and protect them. But let's say that let's say you're 40 years old and you plan to retire at 60. And then maybe your plan is 20 times your annual income, right? Point isn't about when you retire. That's a separate discussion. The point is you need to think about how much value you place on your own life and what would it cost to replace you if, God forbid, that worst thing happened, right? So if you had a money-making machine in your basement that pumped out your annual income, how much would you insure that machine for if it broke down, right? How much would you insure it for? Well, you would probably want to insure it for as what it can generate in value for you. So that's why I say 20 to 30 times your annual income is a good place. So 20 times is a good place to start. So now that you know what you need to get a tailored quote that best matches your ability to contribute. So that may look like, $10,000 a year. It may look like $5,000 a year. It may look like $400 a month that you put away and start chipping away into this fund. The point is to find something that you can reasonably do. And be sure to only work with an infinite banking expert again. And remember that you have a lot of flexibility here, because even if you run into some hard times, you can talk with your agent and figure out the best way, because there's a lot of flexibility in paying your premiums. For example, if 1 year you're unable to pay the maximum amount, right, then you can pay the minimum amount. There's a lot of wiggle room in how much you pay in a premium when we set up one of these types of policies. For example, I have a policy that allows me to pay up to $12,000 a year and as low as around $5,000 a year. So if I'm having a great year and I can contribute the maximum amount, then I'm certainly going to do that. If I'm running into some tougher times, right, I had to take out a policy loan, dip into some of my funds, right, then that year I may pay my $5,000 premium, right? Or let's say that I needed, for some instance, to take a policy loan to pay a premium. I could do that if I needed to. Essentially, it gives me the wiggle room to work through difficult times and cover myself the entire time. And that's the whole point of maximizing the efficiency of your emergency fund. I truly hope that this was helpful to you. I hope that some of the things I've learned I can convey effectively to you. And I hope that if you have more questions or want to learn more about it, that you continue to check out some of the videos that I'm going to put out, and feel free to reach out to me at any point. I'm happy to chat and help however I can.